Hello everyone, I'm Janairo, an equity research analyst from Unicapital Securities, and welcome to our webinar entitled Preparing for What is Ahead, a review on the impact of a 2-month lockdown. In this webinar, we will be reviewing the Q1 earnings of our covered sectors, and we will also be discussing our own outlook for the possible direction of the respective Q2 earnings. This will be the outline of our presentation for today. First, we will look at how the PSEi and different sectors have performed for the year. Next, this will be the meat of our webinar, wherein we will be reviewing the Q1 earnings of our covered companies and sectors, followed by our outlook for the upcoming Q2 earnings report. After that, we will be giving our top 5 company picks, followed by our recommended strategy on this market environment. And this presentation will be concluded with a summary of the main points of our webinar. To start, let us take a look at the year-to-date performance of the various indices for sectors in the PSEi. As you can see, financials and mining and oil sectors are the ones that experienced the largest year-to-date decline as of today. For the financials, we believe that the lagging performance was due to concerns over non-performing loans, given that the disruptions caused by the pandemic significantly hampered the cash flow of various businesses. Next, we have the mining and oil sector. In terms of individual stocks, we have seen a rally in the mining side, which was driven by the surge in gold prices and the recovery in nickel futures. However, the oil sector remained weak given the massive slump in demand due to travel restrictions. As for the resilient sector among the group, we have the services sector. The support in prices for this index largely came from the telcos and the retail companies such as Home, Mrs. G, Pure Gold, RHI, and Wilcon, most of which have benefited during this pandemic. As you can see on the screen, in the year-to-date performance of the PSEi, there were only three names that registered positive price change from the close in December last year. These are namely Tel, Pure Gold, and Globe. All of these are from the services sector and are companies who were deemed as essential despite the pandemic. For Tel and Globe, the telco sector largely benefited during this new normal, given that we are now forced to do most of our activities in the online space, whether it is by ordering food, catching up with friends, and even with our work or classes. Majority of the things that we are now doing require the use of mobile data or a broadband connection, which could potentially impact an increase in bottom line for both Tel and Globe. Now for Pure Gold, which gained 21% as of year to date, the surge in the stock price was largely driven by the massive demand in grocery items, especially at the start of the ECQ when we had to fall in line outside of the stores just to get our grocery items. Now that people are still selective and careful with the food that they eat, it is possible that the demand for the grocery items will be sustained. As for the rest of the names in the PSEi, we expect the rebound in the stock price to be largely dependent on how well the respective industries rebound now that the quarantine measures are gradually lifted and how they will be able to adapt in this new normal. To start with our earnings review, we will be first looking at the banking sector. In the second quarter, we see the record level loan loss provisions to be the main drag for the sector. However, we expect this to be slightly slowed down by the expected trading gains for the quarter as banks unwind their fixed income positions in line with the low interest rate environment. Among the listed banks, BPI was the first one to release its Q2 earnings report, which was in line with our expectations of huge drag from loan loss provisions and support mainly coming from the trading gains. For the cement sector, we are also expecting a massive slump in Q2 earnings, which is basically a follow-through from Q1 as disruptions in construction activity started in mid-March. In terms of recovery, we expect Eagle and Holcim to recover faster than Cemex as the extension of ECQ in Cebu City will likely result in subdued cement demand. Next, we have consumer sector. For the consumer sector, we expect earnings to bottom out in Q2 amid the prolonged store closures as a result of government quarantine measures. But we expect the reopening of malls in June to provide relief to restaurant chains, although we expect slow recovery in footfalls. Grocery operators such as Pure Gold, RHI, Mrs. G, and Mary Mart will continue to benefit from the quarantine-driven increase in sales. As you can see on the left-hand side of your screen, the said grocery operators were way more resilient in Q1 earnings compared to the restaurant operators such as Jollibee, Max's, and Pizza. And we expect this trend to continue in Q2 and maybe until the end of the year. Next, we have the gaming sector, which is one of the hardest hit industries during this pandemic. For Q2, we expect virtually zero revenues from the casino operations as the government ordered its shutdown as part of quarantine measures. Although hotel and retail businesses are currently operating, these segments only constitute about 5 to 20% of total revenues for the said operators. Post ECQ, we expect a rebound in the industry to be slow, given that the international players could have a hard time playing in the facility even after it opens, since most of the travel restrictions are still in place. Now for infra, although construction was already permitted on the latter part of Q2, we still expect a significant decline in revenues and earnings for the second quarter due to the halt caused by the imposed quarantine measures. Additionally, slow recovery of construction activities pose significant risk to cash flows and earnings for the listed companies. For the oil sector, as you can see on the left side of the screen, Petrol and Pilipinas Shell, which are both oil refiners, were hit hard in Q1 mainly because of the massive slump in oil prices, which resulted to huge inventory losses during the period. After hitting the negative territory in April, we believe that oil prices have already bottomed out. And then now for the second quarter, we still expect a loss from Phoenix, Petron, and Pilipinas Shell, but this will now be mainly driven by the depressed demand due to the limited travel restrictions or low sales volume coming from Phoenix, Petron, and Shell. Next, for the power sector, as you can see in the Q1 earnings portion, Mero was the most resilient, mainly because the increase in total power usage in January and February was able to offset the huge decline in the industrial and commercial segment in mid-March. Additionally, given that the sales volume figures in the second half of March for Mer was estimated, we believe that the actual usage was lower and there will be adjustments in the second quarter. Now, in terms of expectations for the second quarter, we expect earnings to bottom out by Q2 as we have already seen resumption of businesses starting June, which will drive the pickup in power demand moving forward. As for the various types of GenCos, namely Aboitiz Power, First Gen Corporation, and Semirara, we expect those with lower exposure in the spot market to be more resilient. Among the three GenCos, First Gen has the lowest exposure in WESM, while Semirara or SCC has the highest exposure to the spot market. Then second to the last sector for our earnings review, we have the property sector. Similar to the other sectors, we expect rock bottom earnings in Q2, mainly because of the construction halt during the quarantine, which will significantly hit residential revenues. Additionally, foot traffic in malls are still below 50% of virus levels, and mall revenues are expected to decline due to rental waves to tenants. For the sector, office businesses are the ones that are expected to be resilient as BPO and traditional businesses continue operations despite the pandemic. Well, for our last sector, and one of the few resilient names during this pandemic, the telco sector. For this sector, we expect a modest earnings growth in Q2 as individuals demand more data services amid the pandemic situation. Due to the rise in the need to adapt in the digitalization, as we can see with schools shifting to online classes and offices shifting to work from home setup, we expect the subscriber base from the fixed line business to also hit double-digit growth this year. Attractive dividend yields for both Globe and Tel are also a bonus. Now we will be moving on to our top 5 picks. First, we have JFC or Jollibee Foods Corporation. Although JFC is one of the companies that were negatively impacted by the pandemic, we believe that the drop in its stock price this year already made JFC an attractive buy at this price. Our expectation for JFC is that it will start to gradually recover as most stores have already reopened and resumed dine-in operations. The fresh front the fresh funding from the $600 million bond issuance should also be able to jumpstart JFC's COVID-19 recovery initiatives. We recommend clients to start accumulating JFC at this level with our fair value estimate of 169 pesos per share. We can expect around 30% upside for JFC if our investment thesis materializes. Now for the power sector, our top pick is Meralco. We like Meralco mainly because of its strong balance sheet and reliable dividend payout, which was at an average of 75% of its core net income in the past 10 years. In terms of its bottom line, we expect the recovery to trend similarly with the resumption of business operations, which have already started to pick up in June. Our target price of 327 pesos per share implies a 25% upside for Mer. Next, we have Meg. We like Meg mainly because it has unbooked revenues of 104 billion pesos, which is equivalent to 3 years worth of booking. Also, due to the negative sentiment towards the property sector, valuation is currently at a deep discount. Meg's PE is currently trading at more than 40% discount relative to its 5-year average. Our fair value estimate of 4 pesos per share implies a 27% upside for Meg. Next, for the cement sector, which we are bullish in moving to 2021, our top pick for this sector is Eagle. We are bullish in the cement industry for next year mainly because of the continuation of delayed construction projects this year due to the quarantine measures. Also because we expect additional construction activity from the government's Build program. We prefer Eagle over Holcim and Cemex mainly because of its strong balance sheet and it has the highest margins compared to its peers. Lastly, we have Tel. Although upside of the current price is limited, we continue to like Tel's business given the expected spike in data demand amid the pandemic. An additional incentive for buying Tel is its attractive dividend yield, which is currently at 4 to 5%, one of the highest dividend yield among dividend-paying stocks. We recommend clients to wait for Tel to pull back at 1,100 pesos to 1,200 pesos per share for a better upside before buying Tel. Given the rally in the previous weeks, If you buy PLDT now, the upside from our FB estimate of 1,450 pesos per share is only at 8%. For our strategy, we recommend clients to deploy a less aggressive approach, given that poor Q2 earnings will likely cause weakness in the market. Since the start of the earnings season, we already saw some weakness in the PSEi, which gives us a clue or a signal of what we can expect once more companies start releasing their respective results. As of now, for the companies that belong to the PSEi basket, only BPI has released its Q2 earnings results. Additionally, we have seen downward adjustments in the Philippines GDP forecast from various global entities, which can potentially dampen investor sentiment moving forward. We also like to note that the continued increase in the coronavirus cases in our country will likely slow down our economic recovery that the government is anticipating by Q4. Next, we recommend clients to prioritize companies that are resilient during the pandemic and those that are set to recover once the demand starts to pick up. Given the fundamentals of the companies that we previously chosen, we believe that these top 5 picks will be able to withstand the storm and bounce back from the pandemic. Also note that not because a company performs well pre-pandemic, it will also perform at the same level once this is over. It is very important to closely track how a company and the industry will adapt in this new normal. For example, you can look at the efforts of various listed companies on improving their presence in the digital world and their efforts in making their products more accessible to the customers. Lastly, and the most important, always exercise proper risk management. In the market, always remember that nothing is certain. What we can do is focus on the variables that we can control, such as risk management. This may be in the form of diversification for investors or cutting your losses for traders. For long-term investors, it is also important to size your investments properly so that you will be able to withstand the short-term volatility and reap the long-term gains along the way. Now, to summarize, we would like to reiterate that majority of the companies in the PSE are expected to record massive slump in Q2 earnings. We expect the poor earnings results in the coming weeks and months to cause some weakness in the stock market, allowing investors to pick up names at more attractive valuations. As we mentioned when we were discussing PLDT, be patient in buying fundamentally sound companies. Do not be aggressive and start chasing prices when you are seeing the names on your watch list rallying. Always patiently wait at your desired levels and at attractive valuations. Next, for the question and answer portion, we'll be answering a stock market related question that we received during the registration process here. But feel free to comment below if you have additional questions that you weren't able to ask during the registration process. Now for the question of Ms. Jo Racelis. She asked if we use a third-party provider like Bloomberg or Refinitiv to generate earnings season data and outlook. For our side, yes, we use Bloomberg to generate past earnings data, mainly because of the ease of collating data when we use a Bloomberg terminal, and the available data in Bloomberg goes beyond the 2 years worth of data that is only available in the PSE Edge. In terms of the outlook, we usually use the data that we get from the Bloomberg terminal as a basis for other assumptions that goes into our own valuation models. An example could be if we are looking at the possible expectations for the upcoming earnings for oil sector, we could be looking at how oil demand and refining margins have been trending recently. So I hope that answers your question. And once again, if you guys have other questions that you would like to ask, Feel free to comment below and we will gladly answer them. So that ends our presentation. Thank you for listening and stay safe, everyone.